Hello, my name is Colin Sturgis. I'm an advisor at Signature FD, and I'm joined today by one of our financial planners, Victoria Santini, to discuss our Wealth Planning 101 video series.
Hi, everyone. Last year, we hosted a webcast to help people that are new to financial planning and investment management learn some basic tips to help them design their financial future. This year, we've decided to expand our webinar into a series.
That's right. Before we dive into the video series topics, I'll give you a brief overview of our firm. Signature FD was founded 26 years ago and is 100% independently owned. We have 114 employees and manage approximately $7.3 billion of assets under management for over 1,700 families. We challenge clients to approach their wealth from both a qualitative and quantitative perspective. We call this process net worthwhile. Our goal is to help people use their wealth, which we define as your time, your money, and your relationships, to live a great life.
As we help people design their financial future, we start by breaking wealth down into four major categories: grow, protect, give, and live. These are the four major areas that people can use their wealth. You can grow it through investments. You can give it through wealth transfer planning strategies to charities or future generations. You can protect it through strategies such as insurance. And finally, you can live it by optimizing cash flow, minimizing debt, and tax management. We will cover each area in the upcoming videos.
The topics we plan to cover are the transition into adulthood. In this two-part series, we'll cover the importance of savings, investment tips, a credit overview, and the pros and cons of buying versus renting. In our third video, we'll cover tax jargon and generosity planning. Finally, we will tackle career compensation, employer benefits, and estate planning.
Our goal is for you to walk away from these videos with a better understanding of financial planning.
We hope the tips and strategies discussed help to set yourself up for success. Thanks for tuning in and enjoy.
Thanks, Colin and Victoria. I'm Allison Porter, a Senior Planning Associate at Signature FD, and I'm going to start the series with a look at the importance of savings. We're going to review questions such as, what are some common savings mistakes that people often make? When should you start saving and investing? And how do you prioritize different savings goals? Let's start with some common savings mistakes. The most important is not saving enough and not saving early enough, which we will discuss next. Another example is thinking that Social Security will provide you with all of the income that you will need in retirement. This is likely not the case, and you will want or need to supplement benefits with personal or retirement savings. You will also want to maximize tax deferral. Utilizing different savings vehicles with different tax deferral capabilities will help with tax planning along the way. This is known as bucketing, which we will talk about in a few minutes. Another mistake is underestimating healthcare costs. It's no secret that expenses are getting more costly, and medical expenses are no exception. When you are older, you will likely have more medical expenses than you do now. If you do not have sufficient savings, out-of-pocket medical costs can eat into the savings you could be spending on lifestyle. Speaking of expenses, you have probably heard the phrase, don't spend more than you make, which is great advice. You need to have your paycheck be able to support your lifestyle without going into debt and still have room to save for the future as well. And finally, in terms of work, you likely won't be able to or won't want to work forever. So you want to make sure you adequately prepare yourself for retirement and the corresponding lifestyle you want in the future. If you're debating when to save, the time is now. One of the most common savings mistakes is people waiting too long to set aside funds for their future selves. If you start saving early and often, you will develop sustainable habits that will stick with you throughout your life. Savings, especially for retirement, will help supplement your lifestyle when you no longer have an income stream to rely on. This chart depicts the importance of saving early and often. In this example, there are 4 individuals: Chloe, Lily, John, and Noah. Each individual saves the same $200 per month, but they save at different times. Chloe, the blue line, achieves a higher ending portfolio balance compared to Lily, the purple line, by starting to save 10 years earlier. This highlights that saving early takes advantage of compounding interest or interest that accrues over time, and that picking the right investments is important for your future self. You can see that Noah, the green line, saves the same amount of money over the same time period as Chloe. However, he invests his savings in cash, while Chloe uses a diversified investment portfolio. Because of this, Noah ends up with a portfolio that is less than 1/3 the size of Chloe's. This demonstrates the importance of savings and how your savings are invested, which we will discuss in a few minutes. Remember, your greatest asset is time in the market, not timing the market. Next, let's look at savings prioritization. When saving, there are many different priorities to consider. On the screen, you will see some different types of accounts and strategies. I should note that everyone's financial plan is unique, and some of these strategies may take higher priority at different times in your life than others. That being said, in general, especially as a young adult, you'll want to have a robust emergency fund of 3 to 6 months worth of living expenses. This includes expenses such as rent, insurance premiums, utilities, bills, car payments, etc. I encourage you to track your expenses for a couple of months, identify your recurring dedicated expenses, and save money in a separate savings account that would provide you with 3 to 6 months cushion. As the name suggests, this bucket of money is reserved exclusively for emergencies, so try not to touch those savings. Next, there is a 401k plan. This is a retirement plan set up by your employer. Funds are contributed or deferred into this plan pre-tax, meaning contributed amounts reduce your income that is subject to income taxes throughout the year. Sometimes employers will offer a match or a contribution on your behalf as well. This can be a percentage of your salary or a percentage of your contribution. Regardless of how the match is set up, try to contribute enough money to your 401k plan to be eligible for the full employer match. This match is a 100% return on the investment that you make in your 401k, and we do not want you to give up free money. High interest loans are next. If you have loans with high annual percentage yields or interest rates, you will want to tackle those balances next to avoid losing money towards those interest payments. When thinking through payments towards high interest debt, there are several different methods to consider, which will be talked about in a later presentation. A health savings account, or HSA, is a tax-deductible account set aside for medical emergencies. This account is only available to individuals enrolled in a high-deductible healthcare plan, and balances roll forward year to year, so funds can eventually be set aside for retirement medical expenses. If you want to continue saving, consider an individual retirement account, also known as an IRA. There are two common types of IRAs, traditional and Roth. A traditional IRA houses pre-tax funds, similar to a 401k, and a Roth IRA houses post-tax funds. This distinction is important because it will determine if the funds are taxable upon withdrawal in retirement. If contributions are pre-tax, then withdrawals will be taxable. If contributions are post-tax, then withdrawals will not be subject to income tax. You can set up either IRA without an employer's assistance. However, you do need to have earned income in the year that you contribute to the IRA. If, after completing the above steps, you have additional room for savings, try contributing above your employer match within your 401k. The annual contribution limit for 2024 is $23,000 for individuals under the age of 50 and is adjusted year to year for inflation. Now would be the time to also look at saving for known future expenses such as education and future home purchases. Finally, consider taxable accounts like brokerage or investment accounts. This type of account is suitable for people who are in hyperaccumulation mode and who will benefit from utilizing a bucketing strategy in the future. Health savings accounts are the only triple tax advantage investment account, and this is why we recommend them to anyone who can take advantage of this tool. It is important to note that these are only available for individuals who are enrolled in a high deductible healthcare plan in the year that the contributions are made. The first tax advantage is that contributions are not included as taxable income in the year that they are made. The second tax advantage is that invested assets grow tax-free. And the third advantage is that withdrawals for eligible medical expenses are also income tax-free. Once you've reached the stage in life where you have savings room for hyperaccumulation, it is important to think through the bucketing strategy. There are three types of accounts where you can invest. First, there is the tax-deferred bucket. These are known as qualified accounts. These would include some employer-provided retirement plans, traditional individual retirement accounts, and some annuities. Contributions to these types of accounts reduce current taxable income, and then distributions from these accounts will be considered taxable income when the withdrawals are made. Second is the tax-free bucket. This includes examples such as 529s, health savings accounts, and some employer-provided retirement plans. Roth IRAs are also included in this bucket. Contributions to these accounts do not reduce current taxable income. However, distributions are tax-free when withdrawals are made in the future. The third type of account is the taxable bucket, also known as non-qualified accounts. These include brokerage accounts and bank accounts. Interest and dividends in these accounts are taxable as they are earned, and gains within these accounts are taxable when they are realized or sold. Having assets in various locations gives people flexibility over time and in retirement to control their taxes. Now that we have discussed when and where to save, I will turn it over to Andrew to discuss strategies for investing those saved funds.
Thanks, Allison. I'm Andrew Foray, a senior planning associate at SIG-FD. Allison's done an excellent job of breaking down account types available at our disposal. But the next question is how to invest the money after determining which account is ideal. How do we sift through the myriad of options available? When we think about investing, it's easy to become overwhelmed. How do I even get started? What's the difference between a stock, an ETF, a mutual fund, a bond, cryptocurrency, or investing in gold? Which of these make the most sense for me? Ultimately, how should I put my hard-earned money to work? When we're thinking through this process, it's paramount to remain true to a few principles. Know the types of investments you have, their associated cost, and understand the best ways you can access different assets. You should develop an awareness of types of risk you're taking and understand that taking on some risk is necessary. Moreover, you should learn the best way to minimize unnecessary risk and avoid emotion-based investing decisions. You should determine what you need for your future and know how your investments are performing to appropriately help you meet your goals. And most importantly, you need to have a plan and stick to it. So how do we start? To help simplify and personalize investing, we should always start at the why. Why have I decided to invest in the first place? What's this money ultimately for? And I get it. For a lot of folks, the initial inclination is to grow their wealth for the future and turn their pot of money into the biggest pot of money they can. While growth is important, of course, we want to view money as a tool rather than a means to an end. How do I use my money and investments and my net worth to accomplish my net worthwhile? In other words, the goals, needs, wants, and things that I value most in my life and want to focus on. Are we catering our investments towards retirement and long-term growth, a down payment on a home, a college fund for our children, or a wedding down the road? Are we also thinking through our current lifestyle versus what we want our future lifestyle to entail? When we view investing through this lens, it gives us the proper perspective on how to appropriately allocate our investments. After determining the goals and needs we have for our money, that allows us to determine our personal risk tolerance, appropriate risk capacity, and determine our liquidity needs and ultimate timeline for our dollars. Our risk tolerance being how much risk we feel comfortable taking on, or our risk capacity being how much risk we can afford to take on, or how much risk makes sense based on our situation. Do we have any near-term needs in the next 6 to 12 or 18 months? Then we may need to set aside funds away from the stock and bond markets and consider other options like a money market or high-yield savings account. When we think through this decision, it's important to focus on the things we can control. One, our asset allocation and diversification. So how much we're investing into each asset class and ensure we invest into different areas of the market to help balance our overall risk exposure. Two, the costs associated with our investments, advisor fees, fees within investment vehicles, and trading fees. Advisor fees can come in an array of forms, but ultimately you want to determine if the value your advisor is providing is worth the cost you are paying. Investment vehicles such as ETFs and mutual funds can have expense ratios, a percentage you pay as an investor for the fund to operate. Or there can be front-end and back-end loads where you're paying a commission fee upon purchase or sale of the fund. Trading fees, where you're paying a fee for the trades you placed. Thankfully, there are numerous broker options available for free trades nowadays. And also asset location. Which accounts are we using for particular investments to help us create a tax-efficient portfolio? As Allison explained, different account types have different tax implications, and that's the case for our investment selections too. We need to properly pair these together to minimize our tax exposure. And last but not least, our behavior. So how you as an investor respond to prevailing market conditions and economic conditions that are unfortunately out of control. In other words, do we follow the emotional cycle of the market? We've just invested and the market is doing well. We're excited and eventually euphoric as we see our account balances rise. But then there's a hiccup and the market and our investments start to drop in value, and we start seeing the wonderful green color on our screen turn red. And suddenly we feel anxious and we get scared and we feel like we're watching our hard-earned money disappear before our eyes, and we're desperate to do something. Till all of a sudden the volatility subsides and we realize it's a blip or bump in the road, and we see the market recover and we have an immediate sense of relief. Unfortunately, the biggest mistake we often see in investing is folks let their behavior be manipulated by their emotions, and their fear drives their decisions. Instead of holding on to their investments during the turbulent times, they sell and consequentially make the loss permanent. That's why it's important to understand the risks that are associated with investing, and ultimately use this information to determine our asset allocation. How much of our assets we should invest into growth-oriented investments like the stock market, and how much of our assets we should invest into income-oriented or safer investments like bonds and money markets. As we look over this chart, we see our return potential alter drastically based on how we allocate our investments. The same is true for the level of risk we take on. As we look from left to right, or conservative to aggressive, we see the average return increase from 5.5% to 10.2%. But at the same time, the worst ever performance year dropped from negative 8.1% to negative 43.1%. These numbers are critical as we intertwine our goals to our investment decisions. Knowing how soon we may need to use our investments, the level of risk that makes us feel comfortable, and the amount of risk that may be necessary to take on to accomplish our goals helps us determine our asset allocation, one of the items we can control. We can establish this using a number of different asset vehicles. Earlier, Allison touched on the variety of investments and savings accounts that are available. And while we need to figure out what accounts are best for us and our goals, we also need to determine which asset vehicles we need to invest within the accounts to best meet our needs and help satisfy our desired asset allocation. An individual stock gives us the opportunity to directly own a small percentage of a publicly traded company, such as Apple, Google, or Walmart. An individual bond is essentially an IOU. A company such as an Apple, Google, or Walmart, or even a government, municipal, or government agency are looking for folks to loan them money and have agreed to pay you back interest on the loan while they use the money to invest or improve the entity with an agreement to return your principal, or initial loan back at the end of an agreed date in the future, a maturity date. Typically, we would associate stock investing with higher growth potential and higher risk, whereas bonds are considered to have less growth potential and lesser risk. Both an ETF, or exchange traded fund, and a mutual fund are a basket or collection of investments that can consist of stocks, bonds, or a combination of the two. The difference being in how they are traded. ETFs are traded on the market daily with their value derived from their fair market value and experience the same price changes throughout the day, whereas mutual funds are executed once per day, with all investors on the same day receiving the same price and a value derived as a net asset value. Either option can provide a suitable avenue for a low-cost, diversified approach. Additionally, we have alternatives consisting of investments perhaps not traded on public markets that provide private access to equity, credit, or real estate opportunities, or investments into gold or other precious metals that can be done on both the public through mutual funds and ETFs, or private markets, or even investments such as cryptocurrency that consist of Bitcoin and other options. So in review, with investing, always remember to stay honed in on your goals to help determine your timeline, risk tolerance, and risk capacity. Or for clarity, if you have any more near-term liquid needs, look for options that help you stay diversified and minimize your costs, such as low-cost exchange-traded funds or mutual funds. Always make sure you're aware of what you're invested into and the risks associated with your investments, and be cautious when speculating or using other high-risk strategies for retirement or other goals. Don't forget about asset allocation and appropriately align it to your goals, risk tolerance, and risk capacity. And also asset location to help you create a tax-efficient portfolio. Lastly, as with anything in life, know when to ask for help. Time, willingness, and ability. Do you feel that you have enough time in your life to make these investment decisions and research on your own? Are you willing to spend the time handling your own investment decisions? And do you feel confident in your ability to do so? If the answer is no to any of these questions, then it may be time to consult a professional for assistance.
Thank you all for joining this session of our Wealth Planning 101 video series. The Signature FD team is thrilled to embark on this journey with you as we delve into some of the intricacies of financial planning and those who are new to it.
Absolutely, Colin. We aim to equip you with valuable insights and practical tips to help empower you on your financial journey. We believe that by considering wealth in our four pillars, grow, protect, give, and live, we can help you navigate the path to a more secure and fulfilling financial future.
As we move forward with the video series, we encourage you to stay tuned in and apply the knowledge you gain for your own financial strategy.
Thanks again for tuning in. We look forward to sharing more tips and information with you. Take care and enjoy the journey towards your net worthwhile.